Let me now bring on board Shane Oliver, Head Investment Strategy and Chief Economist with EMP Capital. Shane, morning. Thank you for joining us. Shane, what is your outlook for India? Have the recent policy moves by the government altered your views? Because last time I distinctly remember when we interacted, you were rather bearish on India.
I think India is sort of moving in the right direction, but it's doing it very slowly. My feeling is that we've probably seen the bottom in India's growth rate. It should pick up a little bit over the course of the next year. We'll probably see one more rate cut by the Reserve Bank of India in the early part of 2013, and that should help drive that recovery and growth. But as global share markets improve, as the Indian economy picks up and that feeds through to stronger profit growth, then I think that should support the Indian share market. Is it going to be going back to where it was a few years ago? In other words, being a strong outperformer? I think not. The Indian share market in a relative sense is still not as cheap, for example, as is the Chinese share market, and the policy moves by the Indian government is still not as positive as one might hope to get overly confident about the Indian share market.
Right. So, Shane, I mean, talking about Europe, is the worst over and is there scope for more shocks?
I think we're probably still going to see more shocks coming out of Europe, but the interesting thing is that the size and the impact of those shocks has been diminishing. And that's reflected in the fact that even though we saw some corrections in world share markets through the course of 2012, mainly emanating out of Europe, of course, those corrections were far milder than what we saw in 2011. So I think the shocks are still there. There's issues regarding Italy. There's an election coming up in February. There's still an issue as to whether Spain will need assistance or not, and when it will seek that assistance. And of course, Europe still remains in recession. But my feeling is that the worst is over for the Eurozone crisis. The consistent response of policymakers, even though it still seems like 3 steps forward and 2 steps back, has been one of more Europe, not less. And the actions by the European Central Bank to help European banks and to help stabilise bond markets in Europe, I think, have done the trick, and consequently, Europe is sort of coming out of the danger zone. I think the worst is over.
Shane, before we wrap, what is your call on equities and commodities as an asset class? To your mind, for FY13, will equity outperform commodities or will commodities outperform equities?
We'd actually see equity markets outperforming over the course of the next year. The gold price, I don't have a strong view on gold. You know, gold was something you invest in if you're worried about the world falling apart and lots of money being printed, but I think there's a limit to that, and as the risk of global meltdown sort of fades, I think the gold price is probably under a lot less upwards pressure and may even come off a little bit over the course of the next year. Commodity prices will probably do well, but the asset class that looks very cheap to me, particularly relative to the safe alternatives like bonds or cash, are equity markets. So I see equity markets outperforming.